Hey everyone, Ben here and welcome to Motivation to Invest. So I always receive many questions about investment property and getting into the real estate business. So in this video, I'm actually going to dive into how you can actually choose which buy-to-let mortgage to actually invest into and use to finance your properties. So let's dive into the contents we're going to cover in this video. So I'm going to cover mortgage type. Should you use a repayment mortgage or an interest-only mortgage? I'm going to cover good debt versus bad debt and the misconceptions behind this. I'm going to cover the perfect debt ratio for you. Mortgage length, should you have a long mortgage or a short mortgage? Should you pay off your mortgage as fast as possible or let it ride for the long term? What's the time value of money and inflation? I'm going to roughly touch on the BRR strategy. I'm going to cover a little bit more on inflation, and then I'm also going to reveal to you guys how you can actually get a low cost or even free mortgage broker. Because when I actually got my first property, and when you buy your first property to actually live in, it can be a really daunting experience. And many of us will go into an estate agent, we don't really know much, and we'll expect them to actually help us and actually provide us impartial advice, but they tend to have ulterior motives, and basically we're like a lamb to the slaughter. And I'm sure many of you guys, if you bought your first property, most likely you paid over the odds in terms of price for the property. Most likely you didn't get a really good mortgage rate despite what your mortgage advisor actually told you.
I want the truth! You can't handle the truth!
You probably paid a sky-high mortgage fee, sky-high solicitor fees, sky-high lawyer fees, and various other fees which you didn't actually need to pay. So my goal on this channel, Motivation to Invest, is actually provide you guys with impartial information for you guys to make better investing decisions. Now, the mission of this channel, the goal of Motivation to Invest, is to help 1 million people become financially free and empower you guys to actually learn and educate yourself in financial markets, in financial education, because this stuff is just not taught in school. So if that sounds like something you're interested in being part of this mission, this movement, then feel free to hit that subscribe button and turn that notification bell on. And if you do find any value in this video at all and you appreciate the research which has gone into it, then feel free to give it a big thumbs up. That helps out tremendously with the channel. And with that being said, let's dive in. So kicking things off at point number one, which mortgage type should you have? Should you have an interest-only mortgage or a repayment mortgage? Well, generally, most people, when they buy their first property to live in, they'll get a repayment mortgage because you want to pay off this over time, because that's the property which you're living in. So when you get to retirement, your property's all paid for and you can sleep well at night. Now, there's nothing wrong with this, and this actually makes sense for a lot of people to do. However, when you get an investment property, many people make the mistake of actually doing the same thing with an investment property, but that's actually more risky and actually more dangerous, definitely in the short term. Because think about your goal. What's the ultimate goal of your investment property? Well, the goal for most people, including myself, is to actually generate cash flow, generate that passive income so you can live the lifestyle you want to live. And that's basically the idea for most people behind an investment property. So following this line of reasoning, the best mortgage type you should use for an investment property is an interest-only mortgage. Now, this may sound a bit daunting for some people, and it basically requires an entire mindset shift. And basically, do not listen to your grandma who will say, pay down your mortgage as quick as possible, pay it all off.
Legalize everything!
You basically don't do that these days. You could do that 20, 30, 40, 50 years ago when properties were really cheap relative to people's salaries, but things have changed and you cannot do that anymore. It's just not really that sustainable. Do the numbers on monthly property expenses. So let's say you have an example, you're making $1,000, £1,000 a month on a property, and you have an expense. So your interest-only mortgage payment, we'll call that £200, $200. For example, if this was a repayment mortgage, you're looking at double that. So you're looking at around $400, £400 for your repayment mortgage. So you're looking at double. And this brings me neatly onto point number two, and that is good debt versus bad debt, because not all debt is bad. And many financial advisors you'll see on television, they'll say reduce your debt, reduce your debt, reduce your debt, and they are right. Basically, for most people, having a low amount of debt does make sense. But as you become more sophisticated and you want to start doing bigger things with your life, you can actually increase your debt, your amount of good debt, in order to actually purchase assets which generate cash flow and actually increase your net worth. So for example, here's the definitions right here. So good debt has the potential to increase your net worth or enhance your life in an important way. Whereas bad debt, this involves borrowing money to purchase rapidly depreciating assets of consumption. For example, if you're racking up credit card bills to buy new shoes, cars, clothes, to buy a bigger house to live in, which you don't really need, you're living way, way, way above your means, then that is unfortunately bad debt. And what can happen is when situations change, if you lost your job or something crazy happened, then you could be left with mounting credit card bills and you could even go bankrupt. So that's bad debt, and you should really reduce that as much as possible. But there's also good debt, and this is the complete opposite situation. So good debt can actually be used to purchase assets. So for example, you can get a mortgage to buy a property. If you didn't get a mortgage to buy a property, chances are you're not going to be able to afford a property unless you have the amount of cash to be able to buy that property, which unfortunately most people these days do not. So you need to get a mortgage to buy a property. The idea of this is you're controlling a more valuable asset with a small down payment. For example, you may put down a 25% deposit if you're buying a buy-to-let property. In the UK, you put down a 25% deposit and you're controlling an asset with 75% above that. So that's the amount of loan on the property. Another example of good debt could be education. So for example, if you take out a student loan, the idea of this is you're taking this loan out to fund your education to actually get you a better job in the future. Whether that pays off completely for some people is debatable, but it is classed as good debt. You could also say business ownership is good debt. So if you're investing into a business or just in general investing in the stock market, for example, you could use leverage. And if you look at various businesses, so businesses have an optimal debt ratio, and this depends on a variety of factors, including the stage of the company, the life cycle of the company. Age makes a big difference. If you're young, then you can afford to take on a little bit more good debt because you have that earning potential ahead of you in the future. Whereas if you're older and you actually have more responsibilities, more liabilities, you might have a family, you might have kids, you might have all these other responsibilities going on, then you may want to gradually reduce the amount of debt you have over time. And this is just a safer way of living. There is a good tip, and that's to reduce the amount of debt you have by 10% every 10 years. So you start with a 75% loan to value. Basically, you put down 25% deposit for an investment property, and you could reduce that to 50% loan to value when you're in your 50s, etc., 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 as you get older. And then from a personality side, it all depends on what you need to help you sleep at night. I know many sort of people in the older generation, and they really do hate mortgages. They want everything paid off and they want to live nice, safe and sound. But really, if you do want to grow in your life, you need to have a balance of good debt. So this brings me on to point number 4, and that is what length of the mortgage should you have? Should you have a long mortgage where it takes a very long time to pay off and you're not actually paying off the mortgage because it's an interest-only mortgage? Or should you have a short-term mortgage you want to pay it off as fast as possible? Well, again, guys, this is a complete mindset change. This is complete against all the conventions. And this is why the majority of people will not be wealthy and not be successful, because most people think, including myself, everybody used to think this, is you get a short mortgage, you want to pay it off as fast as possible. Again, guys, that's not the best way of doing it. If you want to be successful in investing, it's okay for your own personal property, which you're living in, but for investment properties, it's probably not the right thing to do. Again, don't listen to grandma.
Legalize everything!
So, conventional wisdom, pay off your mortgage as fast as possible. Reality, longest mortgage term as possible, 25 years, 30 years, 40 years. If I could get a mortgage which was 100 years long at a great interest rate, I'd take it. So I know what you guys might be thinking now. So if you get an interest-only mortgage, you're not paying out your principals to the amount of debt that you owe to the bank. Correct. So what happens at the end of the mortgage term? Well, this is where things get interesting. So chances are, depending upon your age and your income and various other factors, you could probably speak to the bank and say, you know what, I've got a tenant in here. Can I remortgage again and go for another 10 years? And most likely they're going to say yes. The second option is you can just sell the property. So you can sell the property, pay the bank off, and any capital which is in the property which is actually increased in value over time, then that's the money that goes in your pocket as profit. Of course, you also need to take taxes into account, capital gains, income tax, etc. Third option is to actually pay down your debt over time, and that's a 10% reduction every decade. So you're still doing it really slow. You're not trying to just pay off your mortgage as fast as possible. So on to the time value of money. So this is point number 4. So a bird in the hand is worth 2 in the bush. If someone offered you $1 today in your hand, or $50 today in your hand today, or they say, I could give you $50 in 2 years' time, which would you choose? Well, of course, most people would choose the $50 in their hand today. And this is because of the time value of money and also the risk and uncertainty about the future. So the inflation target for the Federal Reserve, for the central banks across the world, well, definitely in the US, is around 2% per year. So this means the cash in your pocket actually devalues by 2% each and every year. And that's why it's great reason to invest. In the words of the legendary investor Ray Dalio, who's the world's largest hedge fund manager, cash is trash. And the reason he says this is because of this 2% tax which happens and affects our cash. So how does this affect your mortgage and your investing? So let's dive into this example here. So over time, the debt will actually reduce in terms of the amount of pricing power due to inflation. So the property price will generally rise due to inflation. And also, if you bought the property at a good price, then generally it will rise over time. And the property price will also rise if refurbishments are done. So here's an example here. So let's say you purchased a property for 200k and you had it at 75% loan to value. That's a 25% deposit. That's a £50,000, $50,000 deposit which you put down. Now you owe 150k to the bank, which doesn't get paid down, remember, as you're using an interest-only mortgage over a long period of time. So in 20 years' time, let's say the property value is increased to 300k. Now the debt's the same, so the debt's the same at 150k, but now instead of 75% loan to value, this is just 50% loan to value. And as you can see, as the property price increases over time due to inflation, the amount of debt stays the same, and this actually devalues in terms of the pricing power. So it may be quite confusing to get your head around. I recommend probably rewatching this video a couple of times to actually get your head around exactly how this works. But it is a mindset shift, but it does make sense if you think about it logically. And this brings me on to point number 6. I'm going to just briefly touch on this because I've done a full video on this. And this is the BRR strategy. So this is buying the property. So you aim to buy a property below market value. You refurb the property to add value. You refinance the property to pull out that cash, and then you could either rent the property or sell the property. You recycle that cash flow, and then you can go again and buy another property and buy another property and buy another property. And you can actually do this. I know people have used 25k to buy 4 properties, and they've just kept recycling the same 25k. Now, I've done a full video on this, guys, and I'll leave that in the description below for you guys to check out. It's also in this property investing series if you're watching this in the Motivation to Invest Academy. Generally, as I mentioned previously, you go to buy a property to an estate agent and you're like a lamb to the slaughter. You'll walk in there, they know you know nothing, and they'll charge you the massive rates. They'll charge you a big mortgage broker fee. I do recommend you guys use a mortgage broker because they do get better rates than if you actually try to get them privately yourself. And I've actually done this myself. I've researched mortgage deals privately. I've even spoke to the bank directly. And compared to the deal my mortgage broker got me, it was actually much better from the mortgage broker. But many in-house brokers from estate agents will charge you between £500 and £1,000. So convert this into dollars if you're in the US. I also discovered from some insiders inside these mortgage broker firms that they actually get paid from the bank. So they get paid a referral fee from the bank, a referral fee from you. So they get paid twice. And really, I'm sure many of you guys can see that's wrong, and that's really, really wrong, and a really systemic part of the industry, which nobody talks about. Nobody will tell you about this in school, but really it's just ripping people off who are buying their first property. Now, luckily for you guys, if you're in the VIP group or if you're part of the Motivation to Invest Academy, I do have good connections, especially if you're in the UK, of a mortgage broker I personally use myself, who will offer a really low discount rate or may even be completely free. So if you guys do want to know that information, it'll save you between £500 and £1,000, then feel free to check out that first link in the description below if you're not part of the membership group already, or just message me direct if you do want any tips and advice. So that's today's video, guys. I hope you did find it valuable. If you did, feel free to give this video a big thumbs up. That helps out tremendously with the channel. If you haven't subscribed yet, feel free to join the investing family by hitting that subscribe button, turn that notification bell on. And with that being said, thank you guys so much for watching. I hope you have an incredible day, and I'll see you in my next video. Invest safe.